Welcome to The Deep Dive, your shortcut to understanding what's really driving the markets. Today, we're digging into AZZ's first quarter fiscal 2026 results. It looks like this industrial company is making some serious moves, kind of reshaping itself into a focused metal coatings player. We want to figure out what that means for them and, for your view of the market.
Yeah, it's a really fascinating set of numbers. They tell you a lot about what's happening with infrastructure spending and, industrial demand generally. So we'll unpack the financials, look at the strategic plays management's making, and try to connect those dots for the bigger picture.
Okay, so AZZ kicked off their fiscal 2026 pretty strongly, it seems. They're talking about record highs.
Oh, absolutely. Record highs for Q1. Yes, sales, adjusted EBITDA, earnings per share, all hitting records for the quarter ending May 31st. They really seem to be firing on all cylinders.
Okay, break that down a bit. What do the headline numbers look like?
Sure. So consolidated sales were up 2.1% compared to last year, hitting $422 million. But the really interesting part is the profitability. Their adjusted EBITDA margin climbed to 25.2%.
25.2%. It sounds like a decent jump.
It is. That's a 240 basis point increase from last year. So 2.4 percentage points higher. That's a very healthy improvement. And then adjusted earnings per share came in at $1.78. That's way up from $1.46 in the same quarter last year.
Wow. Okay. So a strong quarter. And it sounds like it lines up with what they expected for the full year.
Exactly. It's a robust performance and it tracks right along with their annual guidance. Suggests some real consistency.
All right, strong snapshot. Let's dig a bit deeper. How did the different parts of the business contribute, the segments?
Right. Well, their metal coating segment really stood out. Sales there were up 6% in Q1. And that wasn't just random. It was driven by, infrastructure demand. Things like construction, industrial uses, and especially electrical transmission and distribution projects.
Okay, so that's the core, the galvanizing side.
Yeah, exactly. And it's their profit engine, too. It boasts an adjusted EBITDA margin of, get this, 32.9%. Really industry-leading stuff. They also mentioned getting really efficient with their zinc usage, almost theoretical levels, thanks to their digital galvanizing system.
Digital galvanizing. So that efficiency, what does that actually mean? Better output? Cost savings?
Both, really. It means better control, less waste, which flows right to the bottom line and gives them an edge.
Got it. And the other segment, pre-coat metals. How did that do?
Pre-coat metals also saw some good spots, like in construction, and interestingly, the aluminum container market. Think beverage cans. Now, their sales were actually down slightly, 0.8% year over year, but management was quick to point out that it was mostly customers using up inventory they already had.
So destocking, not necessarily lower underlying demand.
Precisely. And they said they still outperformed the overall market, which is a good sign. Adjusted EBITDA margins there were solid too, at 20.7%.
Okay. Operationally sounds pretty healthy then.
Yeah.
How did this translate to the overall company profits, the gross profit and operating income?
Looking at the whole company, gross profit was $104.1 million. That's 24.7% of sales.
Yeah.
But they were pretty upfront, saying, look, if you back out a $3.8 million restructuring charge and the initial costs from their new Missouri plant.
The Washington, Missouri facility, right?
Yeah, that one. Without those hits, gross margins would have been 1.1 percentage points higher. So the underlying profitability is quite strong. Operating income landed at $69.5 million, or 16.5% of sales.
Right.
Again, compares really well to last year if you adjust for those specific items. And it helps that their overhead costs, their SG&A, were down to a lean 7.7% of sales if you exclude one non-cash item. Pretty efficient.
Now, you mentioned that Avail joint venture earlier. That sounds like a big deal financially this quarter. What happened there?
Oh, it was huge for the balance sheet. They basically sold off most of their stake in the electrical products business held in that Avail JV. And they got a massive influx of cash, $273.2 million. And here's the interesting part. It was booked as cash flow from operations, not just an asset sale gain. Plus, it led to a $165.8 million positive equity in earnings on the income statement. Basically, they got back way more than their initial investment. A really successful exit.
So that huge cash inflow must have dramatically changed their cash flow picture for the quarter.
Dramatically. They generated a total of $314.8 million in cash flow from operations. Just incredible for one quarter.
And what did they do with all that cash? Pay down debt.
You guessed it. They paid down $285.4 million in debt, just wiped a huge chunk off the books. And as a result, their net leverage ratio, that's debt relative to earnings, plummeted. It's down to 1.7 times.
1.7. Wasn't it much higher before?
Oh, yeah. It was 2.8 times just a year ago. So getting below 2 times is a major milestone, puts them in a very comfortable position financially.
Okay, that makes sense. Very clear use of that cash.
Let's switch gears a bit from the numbers to the strategy. What are the actual moves they're making? This surface technologies optimization. Right. So you see how the numbers connect to their strategy? They've been actively trimming the portfolio. They closed a powder coating facility that wasn't making money and sold off a plating facility. These weren't performing well.
So cutting the fat, basically.
Exactly. And the goal is to get that pre-coat metal segment consistently above a 20% EBITDA margin, sharpening the focus on profitable growth.
And what about that new plant in Washington, Missouri, the aluminum coating one? How's that coming along?
The good news there. It's up and running, and they've already shipped the first qualification orders. Management sounds pretty positive. They expect it to become more efficient as sales ramp up, and they think gross margins there will turn positive in the second half of this fiscal year.
So it's still ramping up, but heading in the right direction.
Seems like it. The key is just scaling it efficiently now.
They also bought a company recently, didn't they?
They did, yeah. Just announced it July 1st. They acquired Canton Galvanizing in Ohio. It's what they call a bolt-on acquisition. Small, fits right in, it should add earnings immediately.
So more galvanizing capacity.
Yep. Scales up their main business, adds customers, predictable synergies. They said it was profitable and fits their usual target profile. Very disciplined M&A.
And beyond buying companies, what about technology? You mentioned that digital galvanizing system.
Right, they keep investing there. The digital galvanizing system, or GGS, and something called Coil Zone in the pre-coat plants. It's not just fancy tech, it gives them real-time data, business intelligence, like a central command for their, 46 metal coating and 14 coil coating plants, helps them run things smarter across that whole network.
Okay, makes sense. So how are they thinking about using their money overall, their capital allocation? Sounds like debt paydown was number one this quarter.
Definitely. That was huge. But their playbook is broader. It includes, yes, aggressive debt paydown, also investing in their existing businesses, organic growth. Then there's strategic M&A, like Canton, and they're buying back their own stock opportunistically. They still have about half of a $100 million buyback plan left, and they bumped up the dividend, a pretty significant 17.6% increase from 17 cents to 20 cents per share quarterly.
That signals confidence, doesn't it? Boosting the dividend like that.
Absolutely. And they explicitly said they think their stock is undervalued, trading at around 9 to 10 times forward EBITDA. That's why they're confident buying back shares. They feel the market's missing something.
Interesting. And stepping back, how does this quarter fit into their longer-term story, this transformation you mentioned?
Well, they've really remade themselves over the last decade or so. They're now pretty much a pure-play metal coatings company. Think about it. They added over $1 billion in sales, seriously expanded margins, doubled EBITDA in about 12 years. All through careful growth, both organic and through acquisitions. That big pre-coat metals deal back in 2022, they highlighted that it's actually outperformed what they expected. So the strategy seems to be working.
A successful pivot then. And are they still looking for more deals?
Oh yeah, they said the M&A pipeline's active, especially for more bolt-ons and metal coatings. They also hinted they're looking at potentially larger multi-site deals, but those usually take longer to develop. Keep an eye on that space.
Okay, so we've got the numbers, the strategy. Let's connect it all for the listener. What does this mean if you're tracking this industry, or maybe even AZZ itself?
Well, the big picture is that demand from infrastructure spending is still really strong. That's the key driver. We're talking data centers, electrical grid upgrades, solar projects. Those areas are still growing, and AZZ is right in the middle of it.
Even though some other markets are softer.
Yeah, they acknowledge some softness in areas like agriculture-related industrial, transportation, appliances, HVAC. But the strength in construction and electrical is outweighing that for them right now. That's the main tailwind.
Gotcha. What about bigger economic factors like tariffs, reshoring? Are those helping?
Definitely. The shift to aluminum cans and food and beverage is one driver. But management really emphasized the impact of reshoring, bringing manufacturing back to the U.S. They said things like the Invest in America initiatives and tariffs were boosting domestic steel, manufacturing, warehousing.
And they're seeing proof of that.
They are. They cited data showing imports of pre-painted steel dropped sharply in April and May, down 50% and 38% year over year, respectively. That fits exactly with what they expected the tariffs to do. So, yes, it seems to be providing a real tailwind.
Okay. Any other policy things like those recent copper tariffs or interest rates?
They're still watching the copper tariffs, but they don't expect a major hit to their projects right now. They definitely like to see permitting get easier, and like everyone else, they welcome a Fed rate cut to make financing new projects cheaper. But construction indicators like the Dodge Momentum Index are up, which is positive. And for solar, they see projects potentially getting pulled forward to meet 2027 deadlines, which could be a nice short-term boost in the next year or so.
All right, so looking ahead, what's the official outlook? Did they change their guidance for the rest of fiscal 2026?
Okay, so they kept their sales guidance the same, $1.625 billion to $1.725 billion. And they also kept the adjusted EBITDA guidance range, $360 million to $400 million, saying the midpoint is probably the best estimate.
No change there.
Yeah.
But earnings per share.
That they raised. The adjusted EPS guidance is now $5.75 to $6.25 per share. That's a solid 10% to 20% increase over last year.
Interesting. Why raise EPS but not sales or EBITDA?
Good question. They said it's mainly because of offsetting factors. On one hand, losing the income from the Avail JV is a drag on EBITDA. On the other hand, paying down all that debt saves them a ton on interest expense, which boosts EPS. Plus, there's still some uncertainty around tariffs impacting timing, so they're being a bit cautious on the top line and EBITDA, maybe.
Makes sense. And where do they see future improvements coming from? Margins, et cetera.
Key levers are getting that Washington, Missouri facility fully ramped up and profitable, integrating the Canton acquisition smoothly, just general organic growth and operational improvements, and maybe even refinancing debt at better rates eventually.
Okay, clear path forward. Now let's get to our favorite part, the This Is Not Financial Advice segment. Time to stretch the plausible.
All right, so think about this. AZZ has this super strong balance sheet now, right? Leverage down at 1.7x, heading towards their target of 1.5x. They paid down a mountain of debt. And management is explicitly saying they think the stock is cheap at 9-10 times forward EBITDA.
Okay, so where are you going with this?
Well, they talk about bolt-on acquisitions, like Canton, but with this financial firepower. They could do something bigger. Remember, they hinted about maybe looking at multi-site deals, like 6 to 8 galvanizing or coil coating plants at once, or maybe even a really transformative deal on the pre-coat side.
A whale acquisition, as they say.
Exactly. So the trade idea, again, not financial advice, is maybe go long AZZ, not just for the steady growth, but betting on them pulling off one of these larger market-moving acquisitions sooner than people expect, say in the next 12, 18 months. They're building up cash, cleaning the balance sheet. It feels like they're positioning for a bigger move to consolidate the market. The outrageous part is betting they actually execute on that bigger vision soon, catching the market by surprise.
Interesting angle. Betting on the big splash. Okay, let's wrap this up. To summarize, AZZ started fiscal 2026 incredibly strong. Record results, smart portfolio moves, paying down debt, a very disciplined performance.
Yeah, their financial health looks great.
Yeah.
And those tailwinds from infrastructure and reshoring put them in a really solid spot for more growth and potentially, like we said, bigger strategic plays.
Definitely one to watch. Keep an eye on how they use that cash flow and what that next strategic move might be. Feels like they're building something here.
We certainly hope this deep dive into the AZZ earnings call gave you some valuable insights.
And just to remind everyone, this discussion is purely for informational purposes. It is absolutely not financial advice. Please always do your own research and reach your own conclusions. Until next time, stay informed.